Welcome to the FedLife Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
And hello and welcome to this episode of the FedLife Podcast. I am your host, Dan Sipe. Additionally, as you already know, I'm the branch manager at Sipe Associates and Serving Those Who Serve. I want to start, as I always do, by saying thank you for taking the time to listen. And above all, thank you for your service. Thank you for the service to the country. Thank you for the service to me, all of the citizens. I know the contributions that you make. I remind every breathing person that I have the opportunity to talk to about them. One day, before I'm gone to the great hereafter, I hope that I'll increase the number of people that think about feds when they say thank you. Continuing with my radical behavior of breaking the fourth wall, Podcasting 101, I'm not supposed to talk about dates or times or weather or anything, so it stays evergreen. Once a year, I smash right through it because it's the holidays. I love the holidays. I especially love the holidays after tough years. And now, hopefully for all of you, 2021 was a little better than 2020. If nothing else, at least we got used to some things. But it's holiday time, so I'll begin by wishing everyone happy holidays. This will be sort of our last podcast for this calendar year, back up to the first of the year. And we're talking about some tax strategies. Some of them are going to be workable for end of year. Some of them will be good conversations for the coming year. I've just noticed, and I think Ed can confirm this, in the last month of the year, a lot of people start worrying about what are they going to do with taxes. So this isn't a bad time to talk about that. So Ed, welcome back. I need to give him the quick warning that your opinions, even though they are awesome, are not the opinions of Raymond James of Serving Those Who Serve. And this podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have one, hit us up. Serving Those Who Serve will help you any way I can. If we just answer questions for you, we're happy to do that. So Ed, happy holidays.
Thank you.
We're talking some year-end ideas. Your article is really interesting because it compares and contrasts the Dependent Care Flexible Spending Account, which is available to our feds, and also the Child and Dependent Care Tax Credit, which is a little beefed up right now. This is a great topic. Let's dive into it. Remind everyone what a Dependent Care FSA is.
Okay, Dan. The federal government, or I should say, the federal government allows executive branch employees to participate in what's called the Flexible Spending Account Program. It's called Federal Flexible Benefits Plan. And there are two types of flexible spending accounts that are available to federal employees. One is a healthcare FSA that reimburses employees for out-of-pocket medical, dental, and vision expenses. And the other type of flexible spending account is what's called a Dependent Care Flexible Spending Account, in which employees can get reimbursed for their expenses incurred for an employee to pay for dependent care and that dependent includes a child or a dependent adult, or it could be a dependent spouse. We'll explain what I mean by a dependent spouse here in a moment. The money that's contributed to a dependent care FSA, like a healthcare FSA, is made from the employee's gross salary. It's deducted before all tax is taken out. That money will be used to reimburse the employee for, let's say, daycare expenses or nursery school expenses, or for adult daycare, someone comes to the house to take care of a dependent adult. Again, the money being reimbursed is money that has never been taxed by the employee. So the employee would pay the expenses with after-tax dollars, but get reimbursed with pre-tax dollars.
Gotcha. And there are contribution limits, correct?
The IRS has imposed contribution limits that can be made to a Dependent Care FSA, and these limits actually haven't changed over the years, believe it or not. The amount that can be contributed to a Dependent Care FSA is a maximum $5,000 for a single individual, or a couple married filing a married couple filing jointly, or if the married couple files separate, they're allowed to contribute a maximum of $2,500 to a Dependent Care FSA in this case for the year 2022.
So there's rules around it. A couple of terminologies here: qualifying person and qualifying expenses. So why don't you take us through that?
Qualifying persons for whom the person is being reimbursed for these dependent care expenses include a child who is under the age of 13, who has to be claimed as a dependent. Now, the reason I'm saying has to be claimed as a dependent is because let's take the example of a individual who is single or files as head of household, and they're claiming their child as a dependent in the current year. Their former spouse, on the other hand, would be entitled, actually, if they're paying the expenses of the daycare expenses for that child, but only if they claim that child as a dependent for the year in question. Keep in mind that in case of a divorce, that the couple has to decide which child, who can claim the child for a year. They come up with some of their for example, one spouse says, I will claim the child as a dependent in odd years, like 2021, and you can claim the child as a dependent in even years, like 2022. Well, the parent who's paying these daycare expenses, let's say, we'll talk about what the qualifying expenses are, they may be paying it, but if they can't claim that child as a dependent, they cannot use their their Dependent Care FSA, or we're going to talk about in a few moments, the tax credit for that year, because they cannot legally claim the child as only the parent who claims the child as a dependent for the year. And then the year they do claim it, then the parent can use their their Dependent Care FSA to get reimbursed for the dependent care expenses. Again, the child has to be under the age of 13. And in fact, with the year that the child turns 13, up until the month they turn 13, any qualifying expenses can be counted, can be used, are qualifying expenses as far as being reimbursed for the care. But the month they turn 13, at that point, no more benefit from the Dependent Care FSA. So that's one category. Another category is a disabled spouse. A disabled spouse, either who's disabled because of due to the mental or physical condition, who is unable to take care of themselves, who lives with the other spouse, and that other spouse has a Dependent Care FSA, then the spouse who owns the Dependent Care FSA can withdraw money from the Dependent FSA for expenses incurred as a result of someone, let's say, coming to the house to take care of the disabled spouse, or if, let's say, the disabled spouse has to go to an adult daycare center during the day while the other spouse works, those expenses would qualify for expenses. And finally, a disabled person not able to care for himself or herself, for whom the individual can claim as a dependent. Let's say we have an individual who has a parent, mom or dad, who cannot take care of himself, and mom or dad can be claimed as a tax dependent. The individual has to pay for daycare expenses for their parent. As long as they can claim their parent as a dependent, then they can use their Dependent Care FSA to be reimbursed for expenses incurred in taking care of the parent. Let me just say one more thing, that there's certain conditions, they must fulfill certain conditions to claim someone as a dependent. And one of those conditions is that the person you're claiming has to have gross income of less than $4,300. That is not the case when it comes to a parent who's, let's say, is disabled. They can be claimed as a dependent for purposes of the Dependent Care FSA.
Okay.
Qualifying expenses for the Dependent Care FSA include amounts paid for household services and care of the qualifying person, while the individual, let's say the federal employee has this dependent care, the federal employee has to work, or they're looking for work. Let's say they're unemployed, they're looking for work, and they have to have someone taking care of their dependent child, adult daycare for adults. That would also qualify for reimbursement, okay? Household services are ordinary and usual services done in and around one's home that are necessary to run one's household. Those services include the services of a housekeeper, maid, or cook, so that the person who needs this care, the person will be there to serve them. Child support payments are not qualified expenses. The cost of care provided outside the home for any dependent under the age of 13. And that would include, for example, a daycare center for children, nursery school, tuition, before and after school care. Let's say you have a child who is in kindergarten or above, who's under the age of 13, and you have to drop off that child early in the day. Say school starts at let's say at 8:30, but you drop off your child at 7 o'clock because you have to go to work. That before school care would be eligible dependent care expenses for the purposes of the Dependent Care FSA. And then your child has to actually stay after school. School normally ends, let's say, at 3:30, but you can't pick up your child until 5 o'clock because you're working. That post-school, after-school care expenses would also qualify for the dependent care expenses. Summer day camp has to qualify. It doesn't have to be the usual day. It can be a specialty camp like basketball, soccer camp, drama camps, computer camps.
Wow.
But I emphasize, Dan, it has to be a day camp. If your child goes to overnight camp, sorry, no benefits.
Interesting.
I have to be honest with you, Dan, that when I saw that, when I got involved in this business years ago, that overnight camp tuition does not qualify for dependent care. Congress wrote the law, of course. I said Congress knew what they were doing in that case. But think about this. A person who can afford to send their child to overnight camp, do they really need a tax break? So I said, yeah, that was a smart move. That's a summary of qualifying expenses.
All right, Ed, I think that gives us a pretty good handle on the Dependent Care FSA. Now tell us about the dependent tax credit, because for 2021, there was a bump to that, correct?
Yes, Dan, there was a bump to it, but only for 2021. Again, this is 19 pandemic legislation passed by Congress. With the dependent care tax credit, it works a little bit different because, let me just say this. We talked about the Dependent Care FSA, which you're contributing your gross salary into this account being reimbursed for those expenses. Again, you're being reimbursed with money that has not been taxed. You cannot use those same expenses for the dependent care that you have in the Dependent Care FSA, and then claim a tax credit for those child and dependent care expenses when you file your taxes the following year.
Makes sense.
With a dependent care tax credit, you get a tax credit, and I love tax credits because they reduce your tax liability for the year dollar for dollar, whereas a deduction only results in a reduction in your taxes in terms of a percentage of the expenses that you're paying. A tax credit is a dollar for dollar reduction. The difference in tax relief between the Dependent Care FSA and the Child Dependent Care is that with the Dependent Care FSA, the employee uses before tax salary, federal for all taxes, federal, state, Social Security, Medicare Part A, to contribute to the FSA. With the Child and Dependent Care tax credit, the employees pay the qualifying child and dependent care expenses with after-tax dollars. And when the employee files their income tax that year, the employee uses those expenses as a basis to compute a tax credit. A tax credit, once again, reduces the federal tax liability dollar for dollar. For 2022, one could receive what's called a non-refundable tax credit, meaning that you have to have a tax liability of up to $1,050 for one dependent, qualifying dependent, or $2,100 for more than one dependent. The maximum amount of qualifying expenses that may be used to calculate tax credit is $3,000 for one dependent and $6,000 for more than one dependent. The dollar limit for more than one dependent does not need to be divided equally among dependents as a total dollar amount.
Okay.
Now, for 2021 only, those limits were increased. Those limits were increased dollar-wise for the dependent care FSA. You can put in there up to $10,500 for one or more qualifying dependents. $10,500, but that's only for 2021. For 2022, it reverted back to the limits we mentioned: $5,000 for single or married individuals who have more than one dependent, and $2,500 filed married filing separately. The question comes up: what is more beneficial, the dependent care tax credit or the dependent care FSA? In the column I wrote, I had an example. I did a side-by-side comparison. And generally, the pre-tax dependent care FSA came out ahead a little bit. Not much, but a little bit.
Sure.
But please keep in mind that the difference between using a dependent care FSA versus a tax credit will depend on several variables, including your tax filing status, your income level, your dependent care expense amount, et cetera. But as a general rule, this is what I concluded. For individuals who are in a 22% or higher federal marginal tax bracket, they're in a state marginal tax bracket of more than 5%. And most people are. The dependent care FSA is better, resulting in more what I call net cash. You come out ahead a little better when you use the dependent care FSA. I will tell you, though, if Congress raises taxes, federal taxes, which they likely will, then the dependent care FSA will definitely be a better deal for most people.
Sure.
That's what I concluded.
Okay.
I also recommend that people not just concentrate on the federal level. They also have to talk about their state, because the states also give some benefits for the dependent care expenses as well. I know here in Maryland, I live in Maryland, that Maryland allows you to deduct take a full deduction for your dependent care expenses, the money that you had contributed to your dependent care FSA, which results in tax savings for the state. So that's my general conclusion.
Hey, that's great stuff, folks. Definitely go to fed-zone.com so you can read through Ed's example. A lot of great stuff in there. Ed, let's turn to sort of a final year-end topic here, that December may be a good time to do a Roth conversion. Now, we've covered Roth, we've covered traditional throughout the year, so people have that out there. Why do you think that might be, that December might be a good time?
Well, December is a good time of year because, number one, let me just mention, Dan, that when you do a traditional IRA conversion to a Roth IRA, that is a taxable event. What you're doing is you're taking a pre-tax account, a traditional IRA, or for that matter, many federal employees are not aware of this. One of the things you can do with your traditional TSP is to transfer to a Roth IRA. If you're over 59 and a half still working, or if you're retired from federal service, you are allowed to transfer your traditional TSP to a Roth IRA, but that is a taxable event. Here's the point there. Whatever the amount of your traditional IRA that you're converting to a Roth IRA, whatever you're transferring from your traditional TSP to a Roth IRA, the amount that you're converting or transferring is fully taxable income. The more you convert, the more you transfer, the more taxes you want to pay. You want to make sure that if you're going to do this conversion or transfer of your traditional TSP to a Roth IRA, if you're eligible this month, that you be careful not to transfer so much that it's going to push you into a higher overall marginal tax bracket. That includes federal and state. You don't have to pay more tax than you have to. The reason this month is a good month to do it is because, number one, most people have a really good idea what their taxable income is going to be in 2021. It's the end of the year. They add up all their salary, they add up their interest income, any withdrawals they made from, let's say, their TSP, any IRA distributions, capital gains they may have occurred during the year where they sold. They have a good idea. What I suggest they do is that they work with a qualified account to see where they stand as of now, what marginal tax bracket they're in. And if it turns out that they have room, they can afford to take on more income so as not to push them into a higher marginal tax bracket, now is the time to do it before January 1st.
Mm-hmm.
The general rule then is if it means paying less tax now as a result of your conversion or transfer compared to what you're going to pay in the future had you not done this conversion or transfer, that is down the line, if you took that money out of that traditional account, you'd end up paying more taxes compared to any benefits you got when you put the money in,
sure.
Then it makes sense to do that conversion or that transfer, that conversion or transfer now.
Okay. You also share a big caveat in your article that there's no more Roth conversion do-overs. That sounds scary. Talk to us about that.
The Tax Cuts and Jobs Act of 2017, one of the provisions of that act was it got rid of these so-called do-overs. Before the Tax Cuts and Jobs Act of 2017, individual, let's say, converted a traditional IRA to a Roth IRA.
Mm-hmm.
Let's say they did it this month. Let's say they did it in December. Let's say December 2016. And let's say they converted 100,000 to a traditional IRA to a Roth IRA. And they were in a 28% tax bracket. So they would owe 28% of $100,000, which is $28,000 in federal tax. Another, let's say $8,000 to the state, 8% tax rate to the state. Wow,
mm-hmm.
that's what, $36,000 they owe?
Mm-hmm.
And what would it be due? If they converted in December, let's say December 2016, the tax due is by April. They have to pay that tax due by April 15, 2017, tax filing deadline.
Gotcha.
The person, oh my God, I don't have the money. Come spring, they said, I don't have the money to pay the tax on that conversion. All they would have had to do is to contact the IRA custodian and said, I made a mistake. I really didn't mean to do that. Let's pretend it never happened. And they could do that. It's called a recharacterization of a conversion. Recharacterize that. You could say to the IRS, I didn't mean to do that. IRS would say, that's okay. We'll forget about it. Wouldn't that be nice? I wish we could do that with our other things, in terms of, but you can't. But the 2017 tax law, the Tax Cuts and Jobs Act, did away with that. Now you cannot do over. Once you've done it, it's finished. That's it. You're stuck. You owe that tax.
Gotcha.
So if you're going to do this, make sure, I always say, anybody who's doing traditional IRA conversions to Roth IRAs, anybody who's transferring traditional TSP funds to Roth IRA, one very important requirement, have the liquid assets, the money. I mean, money sitting in a savings account, in a money market account. Make sure that money is sitting there, enough money to pay the federal and state taxes due. They will not. Your IRA custodian, the Roth, the TSP people will not withhold any taxes from the amount that you're converting or transferring to a Roth IRA. You have to pay those taxes from an outside account. So please make sure you have those liquid funds.
Gotcha. And you have a couple of finer points here that you point out that doing the conversion before you're required to do required minimum distributions and before starting Medicare might be a good idea. Why don't you expand on that a little bit?
The idea is that those people who own traditional accounts, traditional IRAs, traditional TSP, you can leave that money alone. You don't have to touch it. But when you reach what's called your required beginning date, that is, for most people that get born after June the 30th, 1949, your required beginning date is April 1st, following the year you turn 72. What that means is, at that point, you have to take what's called a required minimum distribution, an RMD each year for the rest of your life. And what is that RMD how's that RMD determined? It's based on your account balance. Mm-hmm. The higher your account balance, the more money you have to withdraw each year in the RMD and have to pay tax on. If somehow you can decrease that balance, either taking the money out before you reach that required beginning age, or in this case here, converting your traditional accounts to Roth account, to a Roth IRA. That money will not be there and counted as part of your traditional balance, meaning that your R&D will be lower.
Gotcha.
You should ideally start this process, let's say, long before you reach the age of 72. Ideally start in your 50s before you get to age 63. I'll talk about that why in a moment. But you should do a little bit each year. Start converting that stuff before you get into your mid-60s. Once again, Dan, to do this, number one, work with a qualified tax professional. And number two, have a sufficient amount of liquid funds to pay the taxes due on these transfers or conversions. Regarding Medicare, there are a couple parts to Medicare that I recommend that federal retirees enroll in. Medicare Part A, the hospital insurance, which is free, but Medicare Part B, the medical insurance, is not free. You got to pay monthly premium, and what you pay for your monthly premium for Part B is determined by your what's called your modified adjusted gross income, your modified AGI. For most people, it's going to be their AGI. What's included in your AGI? All your income, which includes your annuity, which includes Social Security, which includes traditional TSP withdrawals, traditional IRA withdrawals, capital gains, et cetera, et cetera. But Roth IRA distributions, Roth TSP distributions are not Roth distributions. Roth IRA, Roth TSP are not included in your income, assuming they're qualified. They're qualified distributions, and therefore they will not be part of the equation to determine your adjusted gross income once you get enrolled in Medicare Part B.
Gotcha.
So by converting, what I'm saying, Dan, is by converting your traditional IRAs to Roth IRAs, by transferring your traditional TSP to Roth IRAs, pay the taxes due. When you turn 65 and you have to worry about what you're going to pay for Medicare Part B, any distributions you happen to make from those Roth IRAs will not be included in the equation to determine what you're going to pay for Medicare Part B year in and year out. This is for the rest of your life.
One of your final thoughts, Ed, in that article is you remind feds that the Roth needs to be held for 5 years before tax-free withdrawals can take place, and they need to be over 59 and a half before they start pulling money, correct?
That is correct. When you do a conversion or you do a transfer of your traditional TSP to Roth IRA, in order not to pay tax on distributions you make for that Roth IRA, you have to leave it alone for 5 years. 5 years. Now that's for every conversion or transfers of your traditional TSP that you make to a Roth IRA. Each has a separate 5-year waiting period. This is different than when it comes to making what's called qualified Roth IRA distributions or qualified Roth TSP distributions. In order to take money out of the Roth IRA and not have to pay tax on the withdrawal, on the amount that you're withdrawing, there are two requirements. One, you have to be over 59 and a half. And number two, it has to be 5 years since January 1st of the year you made your very first Roth IRA contribution.
Gotcha.
The same thing is true with the Roth TSP. In order to take money out of your Roth TSP and not to pay tax on the earnings portion, just like the same with the Roth IRA, because the contributions were made to the Roth TSP, Roth IRA with after-tax dollars. We're talking strictly about the earnings. Same requirement. Number one, you have to be at least age 59 and a half when you take the money out. And number two, it has to be at least 5 years, in the case of the Roth TSP, since January 1st of the year that you made your very first Roth TSP contribution.
As I've said before, I don't know how you keep all these topics straight so that you can just talk from memory about them. You are a wonder, but I'm glad you're our wonder. I'm glad you're with us. It's great to have finished, again, breaking the fourth wall again. It's great to have finished another year with you. Here's to an even better 2022. Can't think of anybody I'd rather have on the journey than you.
Thank you, Dan. It's a pleasure.
Folks, that is a happy holiday wrap. This is our final for this year. Again, breaking all the podcast rules. We will be back in the new year. Lots of stuff coming. I want to give a shout out to our engineer, Eric. He's under a tornado watch right now. So retrospectively, when you listen to this, hold a good thought for him because he has just been a champion coming through this with us. And that is a wrap. We are serving those who serve. Be sure to subscribe to this podcast on YouTube and Spotify. Share it with friends, strangers, neighbors, you name it. Check us out on Twitter and LinkedIn, and also the stwserve.com website. Lots of blogs. Ed is up there every single week. Just one more way that we and the guru can work to reach, teach, and serve you. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, happy holidays. Hug your loved ones. Put your feet up. Be good to yourself. And always remember, it's your FedLife. So please, please, please make it a great one, because I, more than anybody, know that you deserve it. Stay well. Happy holidays, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations. Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.